Okay, so I just wanted to give you a quick overview of the big kind of key points that we learned in this last project and show you kind of some interesting things that I think we can see. I think the big takeaway, of course, in this project is that in time series, we really do need to detrend if we have a trend. Otherwise, we end up with very spurious correlations. And so, we could see this happening. I just threw together like quite a long storyboard here to show different things. But again, when I look at, say, let's see, this is GDP and the 10-year interest rate in levels, you see this very strong negative correlation. Again, why interest rates were falling over the entire period. There's a negative trend. There's a positive trend in GDP growth. Now, when I think about this again, it's kind of like, well, I would actually expect that, well, when we do it in growth rates, we don't see much of anything. Now, I'd expect when when GDP growth rates fall, that the Federal Reserve cuts rates. So I would actually expect, and when growth rates rise, I'd expect rates to kind of change a little bit more on the increasing side. And we can actually see that there is kind of a cyclical behavior in rates. Um, when we look into it a little further, actually, there's what we can see is that actually the Federal Reserve actually cuts rates sort of ahead of a recession. So the Federal Reserve is very good at sometimes looking ahead and seeing a recession's coming. They can tell all the telltales. Investments are typically contracting. All the signs that you were reading about in your book. The Federal Reserve is watching investments. They're watching these financial flows. They're watching the overall sentiments. They're watching the markets really closely, and they start to see, hey, guess what? We see a recession coming, and so they respond typically sometimes by cutting interest rates. A lot of times ahead of recessions. So the thing that we're looking at here is actually the correlations within the same period. And so that's one factor actually that we haven't really explored too much in this data set. And we don't see that there is much of a correlation, even though we would really expect there to be kind of in some theory. We do know that the Federal Reserve typically cuts interest rates to spur the economy when the economy's down. We don't see it here though in the data, and it would take some more digging maybe just to even find out if it's there. My point is that we can't necessarily rule it out. We don't find any evidence. So the big thing to take away from what I'm saying here is that when we don't find evidence, that does not mean it does not exist. Okay, this is a very key point in hypothesis testing. We don't, so we can reject a null. Um, but we also just fail. So you can't you can reject a hypothesis, but we can't prove exactly that. So the hypothesis may being that this has a correlation. So if the null hypothesis was no correlation, okay, we could clearly reject it here and say yes, there's a correlation. But on the flip side, okay, the hypothesis of being no correlation, if we don't find it, that doesn't prove that there's no correlation. Okay, so we just actually fail to reject, and it's sort of a weird phrasing of things. But the whole key point of this, and hopefully you got this in your statistical inference, is that not finding something doesn't prove that it doesn't exist. It's just that we don't that the data that we're having is not showing that as evidence. So um, that's kind of what a little nuance is in the statistic part of things. But the big point again is I didn't really wasn't really trying to hit on that point so heavily. The point I was really hitting on was to detrend your data if you're using macro time series, because this course was trying to get you prepared for doing macro analysis. Okay, so the other big thing that we do see is we do see that there's a negative correlation in the money supply. I found that you all have a little confusion with what the money supply actually means. You do need to return to some of your first principles and make sure you understand that you know what the money supply is. Okay, it's not necessarily just about people going out there and spending more money and this type of thing. It's actually has a even though there's a very formal definition of the money supply. that I could tell some people are going to need to brush up on a little bit and go back to first principles of economics, which I kind of assumed everybody had. So I didn't go into talking about what the M2 is. The big story with the M2 again is this just dramatic jump. Look at this, from 15 trillion all the way up to 17.6 trillion, just boom, like that. That was huge. Okay, that was gigantic. That was the biggest single jump in the money supply in US history. And what that means is the US printing presses of dollars were basically just breaking all historical records. And at that particular point, this was the most, this M2 graph is the most shocking macro graph that I ever saw as an economist. When I saw it, I about fell off my chair. Why? Because I knew inflation's a coming, okay, and it's not going to go away. So what do we see? Is we saw a jump in M2. There was a massive inflation that subsequently happened, and then the Federal Reserve has since been responding by trying to rake that money back in. And if you know anything about money supply, how does the Federal Reserve actually push money out? Well, one of the main ways they do it, hopefully after watching the Bernanke video, you understand, is buying and selling different types of assets. Okay, so when the Fed is trying to push money out, how do you get money out? Well, you buy things, right? So the Federal Reserve is buying assets. They're buying assets by the trillions, and we see actually asset prices were skyrocketing during a time when we actually had a pretty sharp recession. So how do we make sense of all that? Well, they're buying trillions of dollars of assets. At the same time, the Federal Reserve is pumping more trillions into the economy through cash transfers. I'm sure you might have all maybe gotten a check from the government, in terms of just cash transfers and also buying assets. There's about 2 trillion or so of cash transfers and another couple trillion in asset buying to kind of make up the overall 4 trillion that happened over the year. So we went from 15.6 and it jumped up actually to about M2 growth 2020. Yeah, so it jumped up to about 19. That's about 4 trillion over that year, and it was actually kind of split up between these asset classes and between transfers. And so when we put that much cash in, asset prices jump. There was a swell in those asset prices, and there's also a swell in inflation, and then the cutback, and that's been where we're at now. Now, because of this dramatic swing. So one thing you should notice is that another thing I want you all to know is why is it so shocking? Because the money supply, when we look at all the other graphs, look at the interest rates, how they jump up and down. If we look at all the other graphs, you see all this jumping up and down. The money supply has been one of the most stable economic graphs that you can look at in the macro economy, except for what, and also, what else has been very stable, if you noticed, is price indexes. Okay, so when we remember, if you looked at a lot of price indexes, we saw that prices were actually fairly stable. So why were prices stable? Prices are how things are denominated in terms of dollars. Okay, it all starts here. It all starts with M2. Okay, M2 is the reason why we had price stability. M2 is the reason why you have those very stable graphs looking at the price indexes. And as soon as you see this jump in M2, you know that the instability is coming to prices. Instability is coming to the dollar. Instability is getting baked into the system right here. And I just wanted to shake everybody who made this. I think this is one of the biggest economic blunders of modern US history, was actually how we responded to the COVID pandemic. And I know people are going to disagree with me about this and say, yeah, but we had to. But guess what? We don't always have to go and try to stimulate an economy and just try to pump it up. We can actually, and we should at different times, in my opinion, kind of pull back and be austere and be a little bit more cautious in some of our approaches. And I think this one right here it's cost us in terms of the stability of our dollar, which then goes to be potentially devalued and questionably taken in the international market. At the same time, another political thing you may or may not be aware of is BRICS. BRICS is Brazil, India, Russia, and China have a very, very open policy or very open agenda to try to dethrone the US dollar from its position. Particularly, China has a strong interest to have the renminbi, the Chinese renminbi, take over the U.S. dollar in terms of how different types of trade is being denominated. There's a lot of geopolitics in the Middle East. You might have heard of the petrodollar. That's the idea that petroleum transfers need to be exchanged with dollars. That was a thing that we had going on with Saudi Arabia for a long time, and it's no surprise that all of this is being brought into question. If you're following the news, you'd see that that there was some softening on the on that stance from Saudi Arabia. At the same time, there's different types of pushes to try to create digital currencies coming out of China and try to actually to dominate more and more trade in Chinese renminbi. That's been something that has been top on their agenda. And this particular spike in the M2 gave them all the ammunition that they possibly needed to wage this international war on our dollar and to try to get others to sort of dump it. And so, on top of all this, we have some other geopolitics that's going on, if you're not aware of, that we also find that that now we're kind of looking at, well, we may or may not pay our bills. And so there's some question as to the credit worthiness of the states. And we've actually been devalued. Our credit worthiness used to be AAA across all agencies. And, two of the main three have already taken us down a notch because of how we question, we basically have these political uncertainties where it's kind of becomes questionable whether we're going to pay our bills or just shut down and not pay our bills. And guess what? That makes creditors, people who hold U.S. treasuries, makes them a little nervous. Now, if those treasuries ended up getting dumped on the international market, okay, which is kind of like what we're looking at right now, this is what we're looking at. We're looking at the risk of the dollar kind of getting dumped in terms of remember, there's as much dollars abroad as they have in our country. So, the dollar getting dumped on an international market would have major consequences for us in terms of inflation, in terms of it would make this little blip that we saw here kind of, I think, look small. And we would look at facing much larger amounts of inflation than even we had during the last few years. If that happens, that's the risk. And on the other side, we also have the risk of, if the treasuries get dumped, okay, if the treasuries get dumped, what's that going to do? What's that going to do? It's going to actually put the price down. That actually makes interest rates or these yields have to go. It's an inverse sort of this relationship. And so what you would end up with is the value of these actually going down. You'd end up with these rates going way up. And with rates going way up, you have to consider, does the government itself actually have, what's their term structure? So when they look at, how much is it long-term debts, how much is short-term? The short-term debts actually would need to get rolled over into new securities in order to keep those going. Long-term debts, obviously, you can hold longer. And I'm not exactly sure, they call that the term structure of that portfolio, how much is weighted on the short-term maturity side, how much is weighted on the long-term maturity side. But if, all those short-term debts, all those short-term bonds that the government's holding, if the interest rates go up, that means they have to keep that debt going. They have to roll them in to treasuries at higher rates, and that increases the cost of borrowing on an already fairly taxed U.S. economy in terms of our national debt, in terms of our ability to keep financing this. All this starts to become potentially extremely problematic. So pretty much this I'm going to cut it. I'll leave it. Is that at the end of this day, at the end of this whole particular class and everything, what I will say is that, hey, we're coming into an election year, and if anyone just says, hey, I'm going to come in and make the next 4 years rosy, yeah, actually, probably not. Okay. I don't care who's going to be in office. I do not have a very rosy outlook in terms of the economy in a lot of ways. But I will say what we can do, and if we execute fiscal austerity can get us out. The problem is, it seems like I don't know who's conservative in terms of being austere, in terms of up there in Washington. It seems like conservatives and liberal sides are both sort of very slush about throwing around cash these days, and that's going to bite us. That could bite us. I'd say we got to watch out. Those are the risks. Okay, I'm not calling a doomsday prophecy here. I'm not setting a doomsday forecast. I'm just trying to illuminate the current risks that we have as a U.S. economy, and hopefully, we can all come together and say, "Hey, guess what? We better fix our budget before it's time, before we come across the deadline." Because sitting here at the deadline and making a stunt about not raising it could potentially seriously bite us. And I know that this is politics and there's all this political shuffling and everything, but we got to get our stuff straight, step across political lines, and fix this country. That's how I feel about it. I feel very strongly about it. As an American, as an economist, this hits home for me big time, and I hope it hits home for you guys. Hope that you've enjoyed all this. Hope that it's given you some insights, if anything, from the class. So these are all things that are not exactly per se, but this is like how I see the U.S. economy, how I see some of these different trends in the money supply and interest rates. Interest rates, that's another thing. Interest rates, we saw them dropped down to zero. Now they're going up. And guess what? The interest rate's going to have an uncertainty category to it. Again, that was my call. So I've made a call about interest rates. I've made a call about potential signs of inflation. And all of this trickles kind of towards investment, the investment climate. Okay, the investment climate, as you can see, investment and GDP are extremely strongly correlated. Okay, extremely strongly correlated. So, in fact, investment, the creation of new investment here is the creation of new capital. Capital being buildings, machines, vehicles, equipments, furnitures, things in production that stick around, not materials that vanish when you make something, or labor that clocks out at night or goes away at different times. Capital is the institutional things that stick there in that production process. That's what we're talking about when we're talking about investment. It's actually called real fixed capital formation is another term for investment. It is not stock market investment. It's not paper money investment. This is real investment that makes the economy actually grow. Okay. It's part of the entrepreneurial spirit. It's a sign of that. It's a sign of installations of capital, installations of technology. That those are the things that drive us forward, in terms of our long-term growth. Guess what? It is actually technology, and the installation of that technology in terms of investments. There's also the creation of the technology side of things, but the installation is where the rubber meets the road, and it's the formations of new types of ventures, of things that's really driving a lot of this stuff. So new ventures, both in all kinds of aspects of the word venture. So how interest rates, obviously higher interest rates, the risk of everything I said means higher interest rates make it more costly to take on investment projects. Those actually reduce the investment flows, and that's what really can stifle an economy. So if we end up in a high interest rate environment with a low kind of investment sort of outlook, that's going to make it hard for us to kind of grow our way out of all this, because economic growth is actually a way out. If we can spur our growth, we can actually overcome a lot of things. It's all about, can we grow? Can we grow as an economy? That's critical. Okay, so growth is super critical. We talked about spurious trends. I've talked about M2. I've talked about a lot of things here. I'm just going to conclude with that. That's my interpretation of the macroeconomy. That's all I'm going to say on it. And I just hope that you've enjoyed. This is a lot of just like talk, kind of table talk, with some different types of nuanced discussions about some methodologies. But I figured it was actually maybe a decent time and an appropriate time to give a talk like this. So anyway, I wish you all well. Please keep in touch. You want to reach out to me at any time after the class is over, please feel free to do so. I encourage you all to add me on LinkedIn and to just stay in contact if I can be of any help of any type going forward. Wish you all the best.